Hi, my name is Abolofia. I am the founder of Lyon Financial Planning. Today, I'm really excited to be talking about TIPS, Treasury Inflation Protected Securities. We're going to cover a lot of ground. We're going to talk about some general information about what TIPS are, what they are, how they may be able to help in your financial plan. We're going to talk about how you would go about designing a TIPS ladder, okay, buying a series of individual Treasury Inflation Protected Securities to help create a stream of inflation adjusted income in retirement. Primarily there, I'm going to use kind of at a high level, I'm going to use the Maxify Planner software to provide one way in which you might go about designing a tips ladder. And then we're going to jump outside the software and actually talk about how you would actually build and actually execute the purchase of the bonds to build the tips ladder. So first off, just a quick disclosure. In this presentation, I am presenting this material in an educational purpose, for educational purposes only. This is not in any way, shape, or form investment, tax, legal, insurance related advice of any kind. Through my firm, Lyon Financial Planning, I do of course provide advice only, flat fee financial planning to clients throughout the country. And lastly, I am not an employee of Economic Security Planning or Maxify. I do offer a co-pilot service using the Maxify Planner software as an independent contractor. So let's jump right in. Just some high-level information about TIPS. Okay, TIPS is short for Treasury Inflation Protected Securities. If you aren't already aware, these are very similar to kind of plain vanilla nominal US Treasury bonds with a twist. And that twist is that these bonds are, rather than being nominal, they're kind of real. Okay, meaning they are adjusting with inflation as measured by the consumer price index. Okay, and so that's a really, really important component, actually the most important component of TIPS and how they differ from traditional US, what I'm going to call nominal treasury bonds. Okay, so a couple more details. One is the principle of these bonds adjusts up and down with inflation and or deflation. Okay, so the principle is, is basically, the face value of the bond. And with a nominal bond, what I'm doing is I'm lending, say, $1,000 to the federal government, and in exchange for them borrowing the money from me, they're going to pay me a stream of income. And then at the end of the term, say it's a 10-year treasury bond, they're going to give me my $1,000 back. Okay, really simple US Treasury bond. A TIPS is different in that the interest payments that I'm receiving after lending that $1,000 are not fixed in dollar terms. They're actually keeping up with inflation. And then when I get my principal back, that principal has also kept pace with inflation over time. So I'm getting more than the $1,000 in nominal terms. I'm getting an inflation adjusted amount. Okay, so first and foremost, the principal of the bond is adjusting with inflation as measured by the consumer price index. The interest rate, often referred to as the coupon of the bond, is fixed. Okay, so right now, as I'll show you on the next slide, TIPS are paying north of 2% above inflation. Okay, so real inflation adjusted interest rate. That's fixed when you buy the bond. The interest rate is fixed. What is not, as I alluded to earlier, is the actual interest payment. Well, how could that be? The actual interest payment that I receive in dollars is variable because it's essentially the coupon rate or the interest rate times the principal, which is keeping pace with inflation. So the amount that I'm actually receiving every 6 months, semi-annual interest payments, is actually going to keep pace with inflation. Okay, it's based on the inflation adjusted principal. Another thing here, as I kind of alluded to above, at the end of the term, or if I hold the bond all the way to maturity, I receive either the original or the inflation adjusted principal at that time, whichever is greater. Okay, so if there's inflation over that time, which is kind of what we would likely expect, then I'm going to receive the inflation adjusted principal rather than what I paid for it. If there happens to be deflation, aggregate deflation or cumulative deflation over that time, I would be protected against that deflation and just receive the original principal. One small asterisk here is if I'm buying TIPS on the so-called secondary market, we'll talk more about that shortly. Essentially, if I buy them from the original purchaser, okay, I'm not actually buying them at auction from the Treasury, then that bond has some built up inflation in the principal. Okay, so when I actually buy it, if there then is a series of significant deflation, I could actually lose money by the time I get the principal back. Okay, just a slight nuance. We'll talk a little bit more about that later. Lastly, there is liquidity with these bonds, right? I can actually go ahead and sell these bonds if I so want or need to on the secondary market. Okay, so it's different than say I bonds or just savings bonds, which are non-transferable. There's no market price. Treasury bonds, nominal and real, that is TIPS, do have a secondary market. Okay, there is a price for these things and liquidity. I can sell them if I need to. Okay, so this is just kind of the recent history of the yields, kind of the total return on US Treasury bonds, both nominal in red and real, that is the TIPS in blue. So you'll see, obviously, these things are fluctuating over time. We'll talk about, you know, some drivers of that in the next slide here. But what I want to point out is a couple things. One is that real rate, just recently between 2020 and 2022 was at or below zero. That is adjusted for inflation. People were lending money to the government expecting to get less back in true purchasing power, in real dollars. Okay, that was very recent. Just over the last couple of years, rates have jumped up significantly. They haven't been this high in almost 2 decades, where TIPS rates are now north of 2%. I think about 2.25% this week. Nominal rates are obviously higher, but again, there's no inflation protection. Okay, so the nominal is certainly different than the real. That's the TIPS. That's what we're focusing on here. All right, so many of you have probably heard, well, there's different ways in which I can hold bonds. That's true of TIPS as well. Okay, and as you'll see in building a TIPS ladder, what I'm really talking about is not buying bonds in a fund per se, but actually buying and holding the individual bonds. Okay, so I just want to say a couple things. Why in the world would I want to hold individual bonds? One major reason is that by buying and holding the individual bonds, holding them all the way to maturity, never selling them, functionally eliminates what is called the interest rate risk of bonds, which is true of all transferable bonds. Okay. What I'm doing is I am functionally making the price of the bond irrelevant. I do not care what happens to the price of the bond because I'm holding it all the way to maturity. With the TIPS, I know exactly what I'm going to get adjusted for inflation. As long as I don't sell it, I literally do not care about the price of that bond. Okay, so a little bit of education on bond prices and interest rates is bond prices move inversely with interest rates. Interest rates go up, bond prices go down. Interest rates go down, bond prices go up. There's a variety of ways in which to think about how this works. I think one kind of simple story is that if I'm holding a bond that is currently paying, let's say I'm holding a nominal treasury bond, it's paying 5%. And interest rates go down. They go down significantly. Okay, they've dropped to about 2%. Well, a lot of people probably want to buy my bond, right? They could buy bonds today at 2%, or they could buy Jay's bond that's paying 5%. They really want my bond. Well, what that means is that the price of my bond is going to go up, such that the total yield or total return on current bonds and bonds that Jay has are going to be equivalent. Okay, so interest rates have gone down in the market, in the economy. The price of outstanding bonds that otherwise had a higher rate has gone up. Okay, another important thing, kind of bond 101 here, is that the fluctuation in price, which again is based on interest rates, is going to be more significant. There's more variability with bond prices that are longer term or longer maturity bonds. If there's 10 or 20 or even 30 years left remaining on the bond and interest rates have gone up or down, the price of that bond or that bond fund, for example, is going to swing a lot more than shorter term bonds. There's just more time for that bond until it matures. Okay, that's kind of what I'm capturing here. I'm showing kind of an intermediate to long-term TIPS fund versus a short-term TIPS fund. The short-term TIPS fund holds a basket of bonds roughly of about, the short-term fund is usually kind of 2 to 3 years on average maturity of those bonds, where the intermediate fund is going to be roughly, say, 5 to 10, maybe 6 or 7 years average maturity. And you'll see, wow, with the interest rates having gone down over this period, bond prices went up, long-term bonds did well, and they just came crashing down, relatively speaking, more so than they have, I think, in almost a century, where long-term bonds really lost a lot of money because interest rates went up so significantly and so rapidly, where shorter-term bonds obviously went down in their price, but not as dramatic. All right, so lastly here, as I had alluded to, we can buy bonds, I can buy bonds individually and buy the actual tips, or I can buy tips or any type of bond in what's called a bond fund. Okay, so you could think kind of a low-cost index fund that holds a variety of different types of bonds. Maybe I'm buying a tips fund that holds actually, tips in the fund, but it's managed by a broker. Okay. Most, although not all, there are some new products, but most bond funds are managed to retain a constant average maturity. Bond funds will always have interest rate risk. I cannot eliminate the interest rate risk by holding the bond fund for longer. The bonds are constantly being turned over by the manager to hold that constant average maturity of the bonds in the fund. Okay, so if I have a short-term bond fund, I'm still taking interest rate risk. However, it's going to be less than if I were to hold a long-term bond fund. The unique thing about the individual bonds, as I alluded to above, is that by holding an individual bond, it's actually decreasing in maturity every year, right? If I buy a 10-year fund and I've held it for a 10-year bond, after 1 year, it's now a 9-year bond, 8-year, 7-year, 6-year. And so the interest rate risk is declining all the way to zero. If I hold the bond for its entirety, all the way to maturity, I do not care about the price. It's irrelevant. I have eliminated the interest rate risk. All right, so let's actually talk about kind of the cash flows from these bonds. If I were to buy, this is a hypothetical example, if I were to buy an individual TIPS today, it's a 30-year TIPS, for example, it's going to create a stream of real inflation-adjusted income for up to 30 years. It's really important to understand how the income is being generated from the individual TIPS. There's two components, as I alluded to earlier. There's the interest payments in light blue. Okay, that's the coupon rate times the principal, which is adjusting with inflation. And then after the 30 years, I'm getting my principal back. This graph is showing kind of in real inflation-adjusted dollars, which is why the interest payment is flat, okay? But I buy the bond, I get the inflation-adjusted interest payment every 6 months. This is just kind of rolled up on an annual basis. And then at the end of the maturity, in this case, after 30 years, I've held the bond all the way to maturity, I get my adjusted principal back. Great, pretty straightforward. Here's the magic of building a ladder. And by the way, a ladder just means I'm buying lots of different TIPS that have varying maturities. All right, so I want some that are going to mature in 30, 29, 28, all the way down, say, to next year. If I want to build a 30-year TIPS ladder, I've got to buy a lot of bonds that are maturing over that time period. Okay, well, the magic of kind of layering these individual bonds over a desired period is that I can really just focus in on the number one question, which is how much inflation-adjusted real income do I want to generate from this TIPS ladder? Okay, the math is quite complicated, which is why we're going to use software to actually solve for this. But the idea is pretty simple. We're going to buy a whole bunch of bonds, and in combination between the interest payments from all those bonds and the returned principal from the bonds, I can build a stream of inflation-adjusted income of really whatever I want. So in this case, I was just saying $20,000 of inflation-adjusted income for 30 years. You'll note here that the interest payments are a relatively larger portion of the total income from the ladder in the earlier years, and it declines to zero. The reason why is that the bonds are maturing in the ladder over time. So I have a whole bunch of bonds in the first year, they're paying me a lot of interest. The next year, I have fewer bonds because some have matured. And so I'm still getting interest from those, but it's relatively smaller, so on and so forth. When it comes to the last rung or the last year of the ladder, the interest payments are really, really small because I only have a handful of bonds left. Okay, but the income from the ladder, this is key, is a combination of interest payments and returned principal. All right, so now let's talk about designing the TIPS ladder. Obviously, I'm going to simplify things here. There's a variety of different complexities depending upon the situation that can make this more complex. So just to simplify this, and then I'm going to jump into the Maxify software to show this. I think the starting point for building or designing a tips ladder is, hey, I want to cover as much, if not all of my quote fixed spending, kind of off the top spending in retirement. So here we're talking about things like housing, taxes, insurance, and what I'm going to call special expenses. Those might be, one-off, lumpy, large, kind of atypical expenses that are not part of discretionary spending. So I want to make sure I fully fund all my fixed spending. So I'll show you in the software, but we can do some algebra, project what we think our fixed spending is going to be in retirement year over year. Let's say it's $60,000 on average in a given year. Well, we want to pause there. We don't want to just go out and build the tips ladder that's going to pay us $60,000 a year. Well, we may, but in this example, that might be too much because we may already have some guaranteed income. Okay, and guaranteed, I'm really talking about Social Security, pension benefits, and/or annuity payments. All right, these are guaranteed in the sense that they'll be there for as long as I'm alive. Social Security probably being the most important because it's inflation adjusted. It'll be there for the rest of my life. So let's say in a hypothetical example, this household or couple has $40,000 in total of guaranteed income. Maybe it's just from their Social Security, and they're going to have that throughout retirement. So if we net that out of their $60,000 of approximate fixed spending, their residual income need, what they might think about at a bare minimum of funding via a tips ladder, would be $20,000 of inflation adjusted income through retirement. Okay, so that's the starting point. There's a little more complexity here, and again, I'll show you this in the software at a pretty high level. But now the question is, do I want more? Maybe I want to buy more tips to cover some portion of my quote discretionary spending. So just to go back here, so fixed spending, housing, taxes, insurance, special expenses, fixed off the top expenses. Discretionary is essentially everything else. For most people, that's their day-to-day annual kind of budget, living expenses, food, leisure, travel, hobbies, maybe health related. Okay, that's my discretionary, for the most part, discretionary spending. Well, maybe I want to actually lock in or create what I'm going to refer to as a discretionary spending floor so that I can really kind of lock in at a bare minimum, covering all my fixed spending and some portion, some amount of discretionary spending in and through retirement. All right. So that just means buying more tips. And the question is how much? There's art and science to this. One approach is what's called upside investing, which I'll show you kind of again at a high level using the Maxify software, which is the idea of, hey, I'm going to put not all of my dollars. I'm not going to put all of my dollars into tips because I want some upside, meaning I want the hope and dream and potential of being able to increase my living standard throughout retirement, and I'm willing to take some risk. Okay, so there's a risk return trade-off here, because now we're really kind of talking about investing to a certain extent, is that I might put a certain amount into tips to cover a certain portion of my discretionary spending, and then I might put the rest into risky investments like stocks, which we hope and expect to outperform bonds, but there's no guarantee. All right. The trade-off here is that the more that I put into tips, the higher would be my discretionary spending floor. That's the red line. I'll show you some actual numbers when I pull up the software. So if I put more into tips, relatively more into tips, I can lock in a higher discretionary spending floor. Versus here, if I put less into tips, my discretionary spending floor may be lower. So maybe here it's $50,000 versus say about $30,000 or so. Okay. Well, by putting more into tips, my potential upside of how much I can safely afford to spend on discretionary spending is relatively less on average or as expected than if I were to just put more in the stock market. Okay, so the trade-off is the higher the floor, the lower the upside. The lower the floor, the higher the upside. The more I'm putting into stocks, the more potential and hope of getting a higher return and therefore being able to fund higher discretionary spending in the future. Okay, so that's kind of the gist, the high level of upside investing. Let me kind of pull up the software here and show you a couple things. Okay, so this is Maxify. Not going to go through all the details of the software. Many of you have probably used it on your own, but at a very high level, if I just run a a base a base report, this is a very simple case. Hypothetical couple, they're both about 70 years old. We're planning through age 100. Okay, the first thing you're going to see is, well, and this is the crux of economics-based planning and Maxify Planner is, what is this couple's allowance? How much can they safely afford to spend on discretionary spending every year adjusted for inflation through their maximum age, year 100, throughout retirement? Okay, so for the next 30 years, this couple can afford to spend $70,000 a year adjusted for inflation on discretionary spending. Okay, and I should also say, well, what rate of return am I using? In this base case, I'm using a safe rate of return. So let's imagine that this couple puts all of their money into tips. Not saying that's a great idea, but for planning, for setting targets for spending, it's the absolute must for financial planning. So let's say they put all their assets into tips. It's a safe rate of return. We know we can get it. Then they can afford to safely spend $70,000 a year. Okay. Their fixed spending is right here. Their fixed spending, again, this is pretty straightforward. I made this rather simple between housing, taxes, insurance, and any special expenses. Their fixed spending is about $60,000 every single year through retirement. So that's exactly kind of what I showed on my slides. This couple would want to make sure that they can, at a bare minimum, if they're thinking about building a tips ladder, to build enough to build a ladder that's generating enough real income to cover their fixed spending on top of their guaranteed income. So let me show you their guaranteed income. Again, I made this very simple. Their guaranteed income is just their Social Security, and they're each getting $20,000 in Social Security. Okay, so 60,000 minus 40,000, the residual income need for a ladder, if they want to fully cover their fixed spending, would be an extra $20,000 a year. I did not build in, for example, in another financial plan, if you have pension income or annuity, pension benefits or annuity payments or something like that, that would also be in here, and I would consider that in terms of making the calculation for the residual income need for the ladder. All right, so that's kind of the bare minimum in which I would think of putting into a tips ladder to cover this couple's fixed spending. Now let's look at the upside investing. And if we click on upside investing here, I'm going to kind of work through this quickly for better or worse. But let's first just kind of gut check it. If we run the program and just kind of bear with me on this, what I've done with upside investing, just as a gut check, let's run the program and say that I'm going to put all my money into tips. Okay, so really what I want to see here is the exact same thing that I've just shown you in the base profile. All right, so if I tell upside investing, I'm actually going to put all my money in tips rather than a certain portion, which we'll do next. The program should come back and say, well, you're not putting any of your money at risk. There's actually no upside investing going on here. Here's how much you can safely afford to spend. It should be the $70,000 adjusted for inflation for life, which I showed you in the base plan. So this is just kind of a gut check. Let's make sure we understand how the program is working. If you scroll all the way down to the bottom, I think these are going to be the figures that are most important for this discussion is, what is the household discretionary spending? Well, it's exactly as I had expected. My floor is $70,201. So just to kind of reiterate what we did to check our intuition is that we have invested no money in the stock market. We've basically just used the upside investing program to confirm our intuition, which is we put everything into tips. This couple can safely afford to spend $70,000 a year. They would lock that in. There's zero upside. Now let's go back and run the program, and I'm just making this simple. Let's just say they invest half of their money into risky assets, stocks, okay? And the rest is going to be in tips. So rather than putting, I think this couple has kind of $2 million in total of financial assets. Rather than putting $2 million into a tips ladder, they're going to put $1 million. We can talk about, why am I choosing those figures? This is kind of an iterative process to really figure out, how much of a discretionary, how high of a discretionary spending floor I really want, or this couple really wants to lock in via tips ladder. For example, I'm just kind of showing us really simple, uh, simple figures here. But the idea conceptually is now I'm actually, this couple is actually investing a significant portion, about $1 million, into risky investment stocks. They're putting the rest into a tips ladder, about $1 million, and then they're putting $1 million into stocks. So now we're going to capture really what the program is set out to do is first and foremost, what's the floor? The floor is going to be lower, right? It can't be $70,000. It's going to be $30,000. They've put much less into a tips ladder. But let me be clear here. This is discretionary spending. This is on top of the fixed spending. So in this program, in this example here, we're not only, have a tips ladder that's generating $20,000 of income to cover the residual fixed spending. It's essentially an extra $30,000 into a tips ladder, or coming from a tips ladder every year, say about $50,000 in real inflation adjusted income every year from a tips ladder, so that their discretionary spending floor is now $30,000. Well, what's the upside? Okay, the upside, well, it depends on returns in the market. And so the upside investing software is kind of using a Monte Carlo simulation. I'm not going to get into the details of that too much in depth here, but it runs it 1,000 times. Let's look at the median kind of typical example of what the upside might look like in the quote 50th percentile. So obviously things are going to look better because I put money in the stock market, and every year I might sell some and move it into tips and lock in a higher living standard, which is the idea of upside investing. So that captures, there's the upside. And as I said before, if we rerun the program and we have this couple put less into tips, we're going to lower the red line, raise the blue line. If they put more into tips, we're going to raise the red line, this is the floor, and lower the upside. That's the idea. This would be an iterative process to really identify the risk-reward trade-off driving this couple's decision. Okay, so let me go back to my slides here. All right, now let's actually get into building the tips ladder. All right, so now we're moving outside of Maxify. This is an example. I'll show you the actual software. It's called tipsladder.com. Incredible piece of free software that actually we put in some basic information. It's going to spit out the exact bonds that I would need to go and buy to build the ladder to create the income stream that I want. Okay, so this is just a printout from the website. I'll actually show it to you shortly. The idea is that I'm going to go back to that simple idea. I want this cover. The couple wants to cover their fixed spending on top of guaranteed income. So they want $20,000 on average every single year for 30 years. That's their annual real income. Okay, and they're going to do it from 2025 all the way out to 2054. That's as far as they can go for 30 years. Couple key points here. The total real income from the tips ladder is $20,000 times 30 years. They're getting about $600,000 back in inflation adjusted dollars. However, interest rates right now are relatively attractive. They're north of 0%. In fact, they're north of 2%. So I don't have to pay nearly $600,000 today for that stream of income. I really only have to pay about $440,000. Okay, so this is the total cost if I were to build the ladder all at once today, kind of by buying these bonds in the secondary market. By the way, that's not the only way to do it. This is just an example, and we'll talk a little bit about that. Some more other important information. Probably the most important information in using this tool and in designing and building a tips ladder is the QSIP. Okay, this is the unique identifier of each individual bond and the number of bonds that I would need to buy. The run year, so in 2028, for example, these bonds here, 14 of them, they're going to mature on April 15th. Here's the coupon rate. Here's kind of their total real return or their yield, and then some additional information we'll talk a little bit about. The net purchase cost is all in what I'm paying for those 14 bonds if I were to buy them today. Okay, let me just actually pull up the tips ladder tool. So if you just go to tipsladder.com, you can see this information below. The key points are the last three. Okay, when do I want the ladder? When do I want the income from the ladder to start? We'll say 2025. I want it to end in 2054, and I want $20,000 of inflation adjusted income. These other things are important. We'll talk a little bit about them, but they're really kind of more advanced. I want, on average, I want about $20,000. I want to choose the bond with the best yield in this example, and some things to do. Well, if I actually can't buy bonds that are maturing in a specific year, which is actually the case, here's some suggestions of how to handle it. You hit go. You can show details, and this is exactly the kind of the report that I walked through before. The other nifty thing is I can actually click on the QSIP. It's going to take me to that specific bond at Treasury Direct, just to confirm, the details of the bond. What is the actual kind of inflation factor or index ratio, as I think they refer to it there. All right. Other key information here at the bottom, the XIRR, that's the internal rate of return. If you're familiar with Excel, that's just on average, what is the yield, inflation adjusted real yield that I'm getting from, the weighted average from all these bonds. Today, the day in which I'm running and I've run the program, it's showing 2.19% above inflation. Okay, so that's just reflective of what the interest rates are on these bonds. Okay, and then some other summary information there. All right, so now let's talk a little bit about kind of the actual execution here. And obviously, I'm not gonna pull up, I'm not gonna actually go through the process of buying an individual bond, but I'll talk at a high level of kind of how this works. And caveat here is there are different ways to buy these bonds. I can go to Treasury Direct. I can buy them directly from the Treasury, and there are some constraints. I can only buy, if I'm going to buy directly from the Treasury, I can't buy those bonds in a retirement account. Okay, that would have to be with after-tax dollars. I'm buying them directly from the Treasury. I'm buying them at auction. And so I have to track the auction. They have to be available. I have to go on. I have to buy them, execute that. I could do that with after-tax dollars. I can also buy TIPS either at auction or on the secondary market, that is from the current owner, through a broker. So for example, a discount broker, Fidelity, Vanguard, people may be familiar with. I can buy the individual TIPS through the broker, okay? And that can allow me, if I so choose to, which is the example I'm going to show today, if I really want to build out the ladder all at once, I can buy lots, if not all, of these bonds on the secondary market and just really build out the ladder today. Okay, so a couple things logistically. Let's say I'm going to do this in a retirement account. Okay, I need to free up the cash in the account. I'm not going to take a distribution. That would be a mistake. I'd have to pay taxes on all those dollars. I might just want to sell. I would just need to sell any current positions that I have. So if I'm holding index funds in my retirement account and I want to put $1 million into TIPS ladder, I've got to free up $1 million of cash in that account. That's step one. I can't buy the bonds if I don't have the cash in the account. That's going to take probably 2 to 4 business days. I'm not taking a distribution. Then, most discount brokers, they're calling their tools kind of the fixed income tool or their bond desk, for example. Basically, I need to find the place, if I'm going to do this online, of the actual window in which I can go and buy these individual securities. And it all starts by just entering the QSIP. So I go to my tipsladder.com tool. I copy and paste the QSIP from the Tips Ladder report, and I put it into the program. This I think was a printout from the Vanguard fixed income tool that they have, and it's going to spit out, hey, here's all the details about the bond, and ultimately I can purchase those bonds through the broker in a specific account. Okay, again, this is just an example on the secondary market. What's really important here, number one, is the QSIP. Okay, that's the be all end all, really. You want to make sure you're buying the bond, which is a TIPS, which is the bond that you really want to buy. That's the QSIP. That's the unique identifier. You want to buy, the number here. This was 11 for the rung in 2025. I want to buy 11 of these bonds. In my opinion, we also want to double check a lot of other things, and this is also just helpful for our intuition. So one is, and by the way, I've had clients, just print out the sheet or have multiple screens or something and actually go through a checklist and make sure that, oh, hey, I've bought those bonds. I've bought these bonds. I haven't bought these bonds. If you're doing it online, generally you can probably do it in a couple hours. You just have to be systematic, or even less, maybe an hour. You can do it systematically. You could also do this on the phone. I find that it's going to take longer, but it may give people more more comfort in the process of doing it with a human on the phone. Okay, so you want to confirm the QSIP. Another thing is the maturity date. Okay, hey, the maturity date should exactly line up on these individual bonds. The coupon rate, that is the fixed interest rate, that should exactly line up with the bond. And then a couple things which may depend on the report that you're getting from the discount broker that is worth checking. One is the yield to maturity. Okay, this is kind of the yield, not the coupon, but the total yield. So it takes into account how much you're paying for the bond, what's kind of the total return on the bond. And you can compare that with what is shown here. This again is on Vanguard. It may show a couple numbers because in the secondary market, and this is one unique thing about the secondary market, is if I'm a buyer, I have to make a bid. The seller is going to have an ask, and we have to agree. Okay, so there's kind of this bid-ask spread, and we're really making a market. I bid X, the seller asks Y, and we meet somewhere in between, hopefully, and execute the purchase. Okay, so depending upon the actual price that is purchased, that it's executed at, the yield's going to be slightly different. Check this should be very close. Based on, the tips ladder tool is based on the ask price, okay, which should be kind of the higher of the two. So it would be the lower of the yield that is presented. Pretty close here. That's good. The other thing is the inflation adjusted principal. So this bond, again, bonds are sold in denominations of $1,000. But for a TIPS, if I'm buying it on the secondary market and there's been inflation over those X years in which, the original owner has held it, and I'm buying it from them, say an institution, for example, well, there's some inflation built up. Okay. The bond is, in this case, worth, the adjusted principal is over $1,200. I want to check that with the factor. It might be shown as the inflation adjusted principal, or it might be a factor, which is just 1.2. So for example, the principal has grown by 20.467% over the time period from its original purchase. Okay, check. The other thing is the price of the bond. This is probably the most complicated, again, because the price of the bond is based on that inflation adjusted principal. So the price is really the inflation adjusted principal times, often bonds are quoted in prices where 100 would be kind of 100%, or 100 is really, if a bond is priced at 100, I'm paying $1,000 for a bond with a face value of $1,000. Okay, so think of it as kind of a percentage. So here I'm just multiplying the percentage, that 97.42 price as listed on Vanguard, times the adjusted principal. I get really close to the ask price. Here, this is from Fidelity, very similar. Check the coupon, the maturity rate, the QSIP, the price, the maturity, the inflation factor. I found that some, including Fidelity, may actually show you the inflation adjusted price, so that makes it a little bit easier. It does the math there for you. Okay, that's really close, 1,174 per bond. So this is just really critical in terms of execution. Make sure you're buying the bond that you think you're buying, and be very systematic in just terms of working through the tips ladder tool. And if you're purchasing these on your own through the discount broker, again, you can also do it over the phone, but it's going to be the same kind of thing. You want to be very systematic about it. Okay, before wrapping up here, just want to point out some other issues, as I'm sure many of you are thinking, well, you're simplifying a lot. Well, yes, of course, because I'm trying to get through this in a relatively streamlined process. So this is just kind of a bunch of other issues that I think are worth considering. Well, where do I actually build the tips ladder? Should I hold the tips in a tax deferred, say tax advantage, like an IRA account, or should I hold it in a brokerage account? I find that most people would say, well, it's better to hold it in an IRA. It's tax deferred. I don't have to pay the taxes on the income from the tips until I actually take a distribution. That may be the case. However, it really depends on the situation, because there are unique aspects to tips. For example, tips income is exempt from state and local income taxes. True of treasury bonds, right? Okay, you have to pay federal taxes, but don't have to pay state taxes. Well, if I live in California and state taxes are really high versus, say, New Hampshire, Texas, or Florida, where there are no state income taxes, well, it makes it relatively more attractive to hold them in a brokerage account or a taxable account. So this is just to say it really depends upon the situation. The other unique thing about tips, which I didn't get into, is this phantom income. Okay, not only do I have to pay tax in the year in which I receive the interest payments, I have to pay tax on the interest payments if I'm holding it outside of a retirement account. I also have to pay tax on the growth in principal. Even though I'm not actually receiving that as an interest payment, it's deferred. I'll receive it when the bond matures. The IRS says, nope, that's considered income. It's taxable, so it's phantom income. That's a little bit annoying. So I wouldn't have to worry about paying those taxes if it's in a retirement account. Another thing is, well, hey, I've got retirement accounts and I have to pay RMDs, required minimum, or take RMDs, required minimum distributions at some point, maybe either age 73 or 75, depending upon my age. It may be useful to think about building a tips ladder to, maybe fully meet the RMDs depending upon the situation, or a little bit more. Either way, it's important to kind of consider the interaction there of building a tips ladder and meeting your RMDs in retirement. What happens in years where there are no tips that mature? Which is true, I think, between 2034 and 2039. I can't buy any tips that are going to mature in that year. So I have to make a decision whether I want to build a ladder, excuse me, where the tips are going to mature before or after the year in which I need the money. There's a trade-off either way. If the bond matures before, then I'm going to have a whole bunch of cash that I could reinvest, for example. Or if it matures later, I might have to sell the bond a year earlier. So there's some interest rate risk. Similarly, what do I do with pre-ladder interest? Okay, if I build a ladder and the income's not starting until 2030, well, between now and 2030, the ladder is generating a lot of interest. What am I going to do with that interest? I might just spend it, I might reinvest it. But more importantly, with the tool, when I'm building the ladder, do I want to consider that pre-ladder interest as part of the income that I need in the first year of the ladder, or do I want to exclude it? Most people may not have, or a lot of people may not have perfectly smooth fixed expenses in retirement. And so building a ladder may be a little bit more complicated. What if I have, relatively highly variable fixed spending, fixed expenses in retirement? How do I build a tips ladder? This really depends upon the situation. One is you can do your best to kind of smooth out those fixed expenses in your plan, or at least in the model. Or you could build kind of multiple tips ladders and stack them. Although there's certainly you don't want it to be too complicated, in my opinion. And then lastly, we talked a little bit about this, buying tips at auction. I can buy tips at auction directly from the Treasury in an after-tax account. I can also buy tips at auction in an after-tax or a tax-advantaged account from a broker, discount broker. Okay, secondary market always has to go through the broker. And there's kind of a difference in terms of competitive bids versus non-competitive bids. That's kind of the bid-ask spread issue that I talked about before. Whole bunch of additional resources which I use to kind of generate a lot of what I shared with you today. treasurydirect.gov is really the key source for getting all the information specifically about tips, or looking at individual tips if you're using the tipsladder.com tool. Okay, so those are those resources. Bond prices, also directly kind of from the Treasury. Wall Street Journal has good. Fred is the Federal Reserve. St. Louis has tons of great data. Okay, the tipsladder.com tool, I've also written a detailed kind of blog article that goes through this process in more detail with some additional resources. And then again, buying individual tips directly through the Treasury or through a discount broker, kind of through their bond window or fixed income tool. Thank you so much for your time. Hope this was useful. If you have any questions, please let me know. You've got my email address. Again, Abolofia from Lyon Financial Planning. Have a lovely rest of your day.